Brokers Alliance and the National Insurance Clearinghouse present the Business Insurance Zone, a Bravo video event. Broadcasting in HD 1080p on Vimeo, YouTube, the Insurance Newsnet, Agent Navigator, BrokersAlliance.com, and on Facebook, LinkedIn, Twitter, and the Insurance Forum. And now your host, the whiz of the biz, Steve Savant. Well, welcome everyone to the Business Insurance Zone, the talk show that spotlights insurance in your practice, keeps you up to speed on insurance news and products, features insurance strategies from top advisors. Get in the zone, the Business Insurance Zone. Our email address on the show is thebiz@brokersalliance.com, or you can call us 1-800-290-7226, extension 147. And I give you those two so that you can do any of your life quotes, any questions you have on disability, long-term care, annuities, or group pension plans. Those are your numbers you want to call in today. We're across the board on all these products. We're one of the leading distribution for insurance products in the nation, and I want you to be able to have access to all the things we're talking about, including a video show like this. And we're in the Business Insurance Zone, and with our disability expert today, and that's Marcy Pruitt. Marcy, welcome to the show.
Thank you.
And again, if you want to talk to Marcy after we get done talking, you say, hey, I have questions, I need to go through this, you can write her at marcy@brokersalliance.com, or just call her 1-800-290-7226. Her extension is 126. Well, on other shows, we were talking about different aspects of disability, because you are all that is disability, okay? The diva of disability, I might add. Today, I want to talk a bit, hone in on both segments on individual DI, not business DI, not group DI, not guaranteed issue, not simplified issue, kind of a group, straight up individual DI. Now, I've heard you teach on your video vignettes that are posted out on Agent Navigator, our site, just basic ideas. You talked about, underwriting. You talked a few ideas that I want to make sure we repeat today, because we want to get into this, but I still have to kind of set a little backdrop. When I'm looking at individual DI, the normal person who's going to pay for it himself, he's not on a plan that has a group DI. He doesn't have an employer picking up the tab. But let's say, and remember, this is the most entrepreneurial environment we have ever been in. So I think we're talking S Corp, LLC, a couple of guys doing a partnership, getting Ks at the end of the year. You know what I'm saying?
Right.
Basic stuff. And people that are out of their garage or whatever, right? But they have 2 or 3 employees. They have business going out. They have a nice practice. They're making 6 figures. And we come to them and say, I've never really approached these guys because S is a pass-through. LLC is a pass-through. The K is a pass-through to the partners. Is it really worth me, again, I'm not talking business, but for individuals who maybe own businesses, is this an area we should be looking at?
Absolutely.
We'll talk about it.
And especially the small business owners, the entrepreneurs. I mean, the larger corporations typically have some underlying LTD through their employer. There's always room to put more on top. But with those individuals, all that income is covered. The K1, the W2, any money that was left in the corp for whatever reason, the percentage of that due to their share of the ownership, commissions, bonus, all income, pass through or not. That is.
Did I hear you just say, you didn't say the word, but retained earnings?
Absolutely.
Well, that is.
If they're leaving it in the corp and
which they are.
Right. Then let's say it's a 50-50 ownership, then half of those retained earnings would be insurable for the owner.
For disability.
Right.
So let's make sure we got it all. Partnership income, retained earnings, right? Their normal W2, if they're pulling whatever their income is. K1 for partnerships, yeah.
Even case by case, if there was a large 179 write-off, that can be credited back.
So even if they're deducting things under Section 179 of a personal nature, that could be brought back in.
Can be.
As a we don't know if it will be.
Exactly.
But it could be a calculation.
Right.
Right. And remember, don't rely on us to do the calculation for you.
Right.
Always talk to your legal or your tax advisor. And if you're with a broker dealer, of course, always ask your compliance officer, hey, what's our stand on this? So we always want to bring out, though, I love this, though, that's a kind of an all-in. Now, let's say I have my retained earnings, I got my K1 form, I got my W2 part of this, and maybe some of this, Section 179. Now that's my total income. Now I have the number that I want to cover as an individual.
Right. And even if you're deferring into a pension or profit sharing or something, that can even be put back in.
So even contributions to a qualified plan.
Right. Because you could take that as income, you're deferring it.
So can I use the word, is deferral a bigger umbrella word for this?
Well,
for
we're
advisors?
looking for the paper trail. How much money is attributed to you in this corporation, in this entity? And if there's a paper trail on where it's gone and legitimately so, then that counts. That's your earned income.
So my earned income, even if it falls under deferral, 401k, defined benefit plan, whatever I'm deferring, you're saying that in that calculation for DI to look at what are you totally making? Well, I didn't know that. And by the way, do you have a nice sheet or some kind of propaganda piece attachment that kind of outlines these basic ideas?
We do, and I think we have a piece that would not only outline based on the entity what is covered, then what documentation is needed to support that as well.
Okay, can I make sure I understand it? So you'll have a document just for S corps, the docs you're going to need, the information you're going to need to assess income.
Right.
And that, whether it's S, it's going to be separate, LLC, or
C corp, sole proprietor partnership. Right.
C corp. Okay, so and we have this. It's kind of a nice digest grid, right? Kind of a cliff note version.
Absolutely.
Well, again, you can call Marcy at 1-800-290-7226, extension 126, or just go ahead and write her, Marcy at brokersalliance.com, and we'll send you that.
Okay, absolutely.
Excellent. I love free. Okay. Now, so I have my income. I've calculated for individual DI. I have my income down now. I've looked at these different silos of income. Okay. Now I have my income. And I'm going to buy this now. I'm an individual. I'm not a corporation. It's a pass-through. Is it worth looking at the word deduction of premium for DI?
Well, if you are not a C corp, it is not deductible for the owner. If the owner were to purchase it on key people or any employees, that would be a business deduction. But the good and the bad, it's not a deduction for them, but it's also a tax-free benefit when the benefit comes in.
I've seen male spouses sell their business to their wife, recharacterize themselves as 100% W-2 non-owner. Is that going to fly, or is that kind of a artful dodge?
Well, we see a lot of businesses owned, jointly, or one's not taking Social Security, or one owns it all and one's taking the income for various reasons. And that will hurt you at the time of underwriting. Just like a sole proprietor, we look at the Schedule C. So even if you own the business and you're married, you take $100,000 home, it all goes to the household, we want to see your W-2 or your split, your share, your K-1.
So there's it's still, we have to look at this as a legitimate accounting practice, not an entity or recharacterization, I think would be the better word, recharacterization of either employment or ownership.
Right.
So that I can really look at this fairly. So, okay, we're going to have to we have to stay above the board.
Right,
okay.
Absolutely.
All right. So now I have my income. I know what I can do now with it. You just told me that. I can't really deduct it for myself as the owner, but if I put it on any of my key personnel, that's okay.
Right.
All right, now let's say I keep it. Now, if I have a disability now, mine comes in free.
Tax-free.
Is that correct?
Right.
Am I still at a cap? What's the cap that I can do? I've added up all my income sources and my deferral incomes, like you said I could do, and now I got a number.
It's typically, the higher you make, of course, the less the replacement ratio. I mean, if you're making $1 million a year, showing taxes on $1 million earned dollars a year, then you're going to be at around 40%. The rule of thumb for anything under $600,000 is roughly 60 to 65% income replacement, because that is what you typically, you bring home a little more than that when you're healthy, working, and paying taxes, is the rule of thumb.
So if I'm pulling down $1 million, and I'm hoping that my boss is listening to this show, if I'm pulling down $1 million, because right now I can get 65, but I wouldn't mind making $1 million and only taking 40 if I was disabled. I'm hoping he's listening to the show right now. But
for that discretionary income, the actuaries don't want to insure that.
Okay. Well,
although you can go, we mentioned Lloyd's, you can go to surplus lines, and they don't have a limit, or they have a 70% limit. But
so you could go up. By the way, everybody, when I think of Lloyd's of London, one of the oldest insurance carriers, I mean, these guys are like 350 years old. I mean, they've been forever. Do they do much in DI, or is it just mostly surplus? Now that you brought it up.
Well, it's surplus, but it's DI. I mean, you would always exhaust your traditional market first,
and then go to Lloyd's.
And then go to Lloyd's.
Okay.
So
if you had something really like a high-end earning client, like we've just mentioned, and or something really strange and anomalous in the client's scenario.
Right.
And how do I know?
Which can be age, which can be travel overseas, which can be medical conditions, high net worth unearned income, because all of the above, the traditional carriers frown upon.
So if I wanted to know if I should go that way, I can just call you on that, 1-800-290-7226, extension 126, or write Marcy at brokersalliance.com. I keep repeating it every show because some people actually will remember it or jot it down the third or fourth time. Yeah, we're a repetitive educational program. Well, now I have my 60%. I know what I'm doing now with 65, maybe more if I want to go to Lloyd's for the surplus lines.
Well, you also bump up against the carrier cap. So even when we say 60, 65%, if you have other coverage in force, if you have group coverage, and each carrier has a issue limit of, like I said, 20,000 is the typical industry limit, and then they'll go up to 30 or 35,000 with group or whatnot. But they also have two columns. They have the taxable column and the tax-free column. So what we've been discussing is a tax-free benefit. If it were a situation where your employer's paying the premium or you're an owner of a C Corp, you can, and it's going to be a taxable benefit, we'll sell you more because we're going to, the net result is the same. After taxes, they want you to have around 60%.
And we're going to do a whole show on employer and corporate DI. That's going to be a whole nother scene, And so when I'm talking to an individual, I got my silos down here. I got all my earning ability, what I make to calculate. And I also see that I'm going to make about 60, 65% if I'm making about 600K or below. So I'm trying to figure out how I'm going to prospect for this, how I'm going to market to this. That's why I'm kind of looking at this, looking at how we're going to do this.
Right.
Well, listen, when we come back from the break, we're going to continue our talk on DI and individual disability with Marcy. You can write her at marcy@brokersalliance.com or just call her 1-800-290-7226, extension 126. And don't forget, you can always hop on our website, www.brokersalliance.com. You're listening to the Business Insurance Zone, the talk show that spotlights insurance in your practice. We'll be right back after the break.
Steve Savant here. For years I've heard that less than 2% of all term life insurance ends in a claim. That's not many, and clients had to die to receive the benefits. That's the old term insurance. Now start selling the new term insurance. The term insurance that covers your client through a chronic illness, a catastrophic event, or a terminal diagnosis, and pays their monthly premium during extended periods of unemployment. What term life insurance can do all that? Western Reserve Alliance Advantage Term with living benefits. No other term insurance product bundles so many solutions to life's unexpected problems. And all in one policy. So for more information, call Brokers Alliance 1-800-290-7226. Stop selling the old term. Start selling the new.
Way to go. Well, welcome back to the Business Insurance Zone, the talk show that spotlights insurance in your practice. I'm Steve Savant, your host, financial color commentator, and interviewer extraordinaire. We're talking about individual DI with our head of our DI department, Marcy Pruitt. Hey, Marcy.
Hello, how are you?
Well, I'm a lot better now that I'm learning about disability, and the reason I'm fronting it in our show, and we've done several shows on this before, and remember also Marcy's out on several of our educational channels on the net, teaching entry-level DI just to get your toe in the water, see if you want to play or not. I say you probably should play because we're always looking for marketing distinctions. How can I get in front of people and look different? What's anomalous on a first contact interview? And I think DI, honestly, I think it's the forgotten indemnification product.
I think it's a great door opener.
I think it is. And now that you tell me all that it does, we don't even want to use the word disability insurance, sometimes I just feel tempted to say, forget that. It's called Paycheck protection, right? But we want to be, of course, compliant and salute the flag and all that. And just remember, on that note, I am not a legal or a tax advisor, so anything you hear on our show, please check out with your CPA or attorney. And, of course, if you're with your broker-dealer, always go to your compliance officer and make sure everything we're talking about, they feel comfortable with, so that you can repeat it with, and not so much verbatim, but that you can repeat it with good confidence that what you're saying is true. I'm looking at our ability to write DI, and I love this last segment we did because we really mapped it out. Now, I went ahead, we mapped it out, and I'm now going to underwriting. I got my qualification, I got my prospect for individual DI. I'm ready to go based on what we said in the first segment. Now I have to see, I'm going to go through my application, and I'm looking for red flags that I'm going, what I offered, right, may not be able to go because we're going to talk about two parts in this. First is underwriting, the physiology issues, and then the secondary issue is the financial issues.
Okay.
So talk a little bit about, I'm in my prospect round, I'm doing my interview with my client, and certain things are starting to come up.
Okay. And field underwriting is so key. And, with the best intentions, an agent goes out and takes the app and just had no idea that a high net worth, more varies by carrier. Traditional carriers, 4 to 6 million. If you have a higher net worth than that, that's not your personal residence or your business, that's a knockout. Unearned income. And alimony can count as unearned income. And agents routinely say, I'm not trying to insure that. Not only is it not insurable, it counts against what you can buy, because when you're disabled, that stream of income will continue, which loses your incentive to go back to work. So, is this the lines you're looking for versus health conditions or some of these things?
No, I like that. I never even thought about it. I'm looking for health, but now that you bring it up, I'm just like, do we have a little sheet of what you would call your knockouts? And that's one of them, alimony.
Well, yeah, short of the whole underwriting guide, and we do the training webinars to help with a crash course.
But is it a digest? Do you have a digest page on this, you think?
Not really. That's something we probably could put together. Something just to be aware of, the questions to ask.
Okay, I want everyone here to just inundate Marcy on this request that she does not have.
So we'll develop
She'll develop it right away in a Word doc that we can attach and send out to you. Because I think I like knockout issues. Hey, why do I even go further?
Well, and it's true because you think, they're healthy. This is great. I have a great client. Unearned income, high net worth, working out of your home 100%. Unless if you're a W-2 employee for a corporation and you telecommute, that's different. If you own your own business and you sit in front of the computer all day, not good.
That's why I work for Brokers Alliance, so I can qualify.
And you get up and go to work every day. There's
every
accountability.
day. They make me come down here at the crack of dawn.
That's right. Hard drivers.
Oh, they are. I tell you what, the young guy's just a killer. He just rides me like a whip. Yeah.
Well, so working out of the house is a concern. They like you to get dressed, go see clients. It's okay to work out of your house, but at 25, 30, even 50% of the time, it's required that you leave the home and go see clients or do something.
Even in this commuter age
Absolutely.
and home businesses and employers that allow.
No, if you're an employee and your employer pays your W-2, that's different. That's
okay.
Work out of your house,
that's
right?
Okay.
If you're
I'm glad
sole
I clarified
proprietor.
that. Okay.
So working out of the home. The schedule. Well, we'll get into the financial.
Right. Anything about the physiology issues? I'm taking my application. I'm going through it. There's some knockout issues here. Just don't even. Because remember, I saw this one case. We were talking about this, Marcy. We saw a guy get super preferred on life insurance.
Right.
And yet he was. I think it was an exclusion, and it was modified on DI, and maybe even I can't remember if it was even declined. It might have been. I don't know. But I guess I'm asking you. There's such a difference between mortality and morbidity underwriting.
Right.
So you could be really good in life and not make the DI.
Well, height, weight, and a lot of things they can deal with a rating or a reduced benefit period, but real knockout and again, there's options, but serious conditions, impaired risk. Mental and nervous drug alcohol conditions, and a lot of carriers pull your driving record. So even driving related, which is lifestyle and morals, etc., that comes into play.
Well, now, I mean, like you have to obey the Ten Commandments morals, or we're just talking about the MVR? Or,
Yeah,
you know?
the MVR.
Okay, I just was curious, like, wow, they bring religion into it, maybe.
Yeah.
I don't know.
DUIs and
DUIs.
and other.
So they're looking
other
for bad boy behavior
traffic-
issues,
Right.
right? Bad boy behaviors. So if you got issues like that,
Right.
you know, and I'm assuming that if you're really a good guy, you know, you're pretty decent. You know, you have an occasional traffic ticket. Who doesn't, right?
Right.
But if you're pretty good, you have a drink of wine once in a while. We're not talking about that.
No, and that is asked. I mean,
Mm-hmm.
you know, as long typically that's going to your liver enzymes will pull that
Mm-hmm.
up. So the paramed blood and urinalysis will take care of uncovering your labs.
I've heard on the life side, I'm sure since it's the same paramed doing the same thing, that you're not supposed to eat 14 hours before you take your exam, right?
Well,
Is
if
that
it's required to fast, typically, right?
So, I mean, because it'll mess with your numbers.
Mm-hmm.
So you have to kind of set that aside, no physical activity, right? Well, no? Or
No,
no?
I don't
For an
know.
exam. Yeah, well, for an exam, if you have to take it for life, you're not supposed to have any physical activity.
Well, see, because you're probably doing EKGs on life, and
Uh-huh.
they're usually not required
Oh,
for a
okay.
DI. So that's probably where you're going with that.
Okay. Well, see,
so-
that's why I'm saying, because a lot of
Right.
our guys are more, maybe our advisors are more life oriented,
Right.
And that's why I want to kind of make the distinction
Well,
in
and
underwriting.
we share the
yeah.
exam, so that's good to know for 6 months. Some carriers a year, but
Wow, a
so when you
year.
go back to deliver the life policy, if you haven't addressed the disability, now's the time.
By
to,
the way, I love that because we talked about in one of our other interviews with you. We talked about cross-selling anyways.
Mm-hmm.
This is a natural. I'm coming with my life contract. That's what I feel is comfortable selling.
Right.
Okay, I come with my life contract. I'm delivering it. I'm going over the policy one more time to, and state why did we buy it.
Right.
I'm trying to drill it into the client. Here's the basics of why we did this, and now I have to say now, I want to bring up this other issue, and I've already taken the exam,
Right.
so I'm golden there. It's just a matter of doing the DI app and
Right.
bringing this up.
Exactly. And the DI app, and there's several carriers do the tele app as well.
Mm-hmm.
But on the medical, some of the knockout kind of diabetes, sleep apnea, real serious heart circulatory,
Mm-hmm.
the mental nervous drug alcohol, kidney issues, cancer. So-
Those are just declined.
It depending on the severity of it, but
Uh-huh.
it would be highly rated and ridered. So
What about the surplus lines pick up after that if it's really that?
the surplus lines will, or Fidelity, for example, and a lot of times either through a bank loan or an employment contract or another reason that somebody has to have the coverage. So even with those conditions, there is a resource there.
So like Fidelity,
Right.
Now, what did they do? It sounds like they're in the substandard
Yeah,
zone.
exactly.
So what did they do now? You're not going to probably get the.
Well, it's usually a graded benefit, and it's a max of 5-year benefit period, and it's expensive and not completely. Again, if you need the coverage or recognize you need it, or there's, you just have to have it because they usually don't put the exclusions on. They'll cover that item, but that's why they charge a little bit more. And then it's a graded benefit for the first 3 years.
I'm just curious. In the world of DI, which you are the diva of all that is DI, how many people have to punt and go to a contract like Fidelity, which is more of a substandard carrier in DI?
Well, about the industry average is about 12% for declines. So, and you probably wouldn't really go to a Fidelity unless you were declined. I mean, because the traditional coverage is still going to give you, 2-year, 5-year, maybe even 10-year benefit period with a rating. And the difference is it's not a graded policy. So with Fidelity, for example, in the first year you might get, the exact number, 60 to 70%, or 40% rather, the next year, so you'd have to be on the claim, on the product, paying premiums for 3 years before you could get 100% of the benefit.
Before you could even collect on anything.
You can collect 40% the first year.
Oh, you can't?
Yeah, so it's graded years 1 through 3.
Years 1 through 3. Okay. Well, I like that because it's an option. I mean, for
Right.
like people that have to have it.
Right.
And it's a little bit more expensive. It doesn't have all the perks and all the other drama of definitions
Right.
that the high-end DI policies have. But hey, again, if I needed
if
it,
you need it, right.
I like that. Now, when I think about just a little last question on surplus lines. Lloyd's of London, I was intrigued by your statement in one of our episodes that we did. You were talking about, they're big players. They play. I've always thought they were, merchant ships and, the uninsurable in life. They take the dead, the dying, the postponed, the heavily rated. but they play in the DI market. And have you seen them, like, have you done any cases lately with them, and why did you go to them?
Well, number one is your athletes, your entertainers. They are
Really?
the go-to for that.
Now, why is that?
Nobody else will take them.
The athletes?
Yeah.
Okay.
Professional athletes, nobody, you need to go to Lloyd's. Because, I mean, first of all, they're very high indemnity contracts. I mean, you can do a $50 million contract on a player in the NFL draft.
Wow.
So, you know, high limits.
The entertainers?
Entertainers.
Well, that I get.
And in addition to personal DI, you know, they can be, you know, tour interruption, you know, so there's other offshoots of that in addition to the personal coverage.
So if we have advisors that are connected into the entertainment or the sports world,
Right.
they could call you on a Lloyd's of London issue.
Correct.
Man, I love that. We are so big at Brokers Alliance that we're playing with Lloyd's of London. I love the enormity of saying I can go to sports and entertainment at the 50 million
There's
level.
really not a risk we can't do with the impaired and the athletes, entertainers, and our portfolio of carriers.
Well, Marcy, I want to thank you. That's really great. You can call Marcy on all this. You know, Marcy at brokersalliance.com or 1-800-290-7226 or extension 126. You can go out to our website at www.brokersalliance.com where you can get any of the quotes you need. I'm Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz today. Get into the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse and Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. You can contact Brokers Alliance at brokersalliance.com or 1-800-290-7226, extension 147.